Jake and Marcus are both 30 years old. They both earn $75,000 a year, and they share the exact same financial goal: retire comfortably and never worry about money again. Jake enrolls in his company's 401k. His employer offers a 4% match, and since Jake contributes pre-tax dollars, his current paycheck barely feels the hit. Uncle Sam hasn't touched that money yet. Marcus opens a Roth IRA and maxes it out. He gets no employer match, and every dollar he puts in is after-tax money. From day one, Marcus's paycheck is noticeably lighter than Jake's. Both men are disciplined savers. Both believe they have the perfect retirement strategy. But by committing to entirely different tax structures today, they have set themselves on two very different paths toward their final retirement balance. 5 years in, the results seem obvious. Jake has $64,000, while Marcus trails at $46,000. This chart shows why Jake is ahead. He captured thousands in free employer match money, and with pre-tax contributions, he paid no upfront taxes to build momentum. Marcus is working much harder for every dollar. In his 22% tax bracket, Marcus has to earn $9,600 in gross pay just to put $7,500 into his Roth IRA. Jake looks like the winner on every visible scoreboard. He has more money in his account and more money in his paycheck. But that high balance hides a future liability that he hasn't accounted for yet. Fast forward 32 years, Jake and Marcus are now 62. On this graph, Jake's 401k peaks at $1.23 million. Marcus is significantly lower at $885,000. On paper, Jake is a millionaire, but every dollar he withdraws is taxed as ordinary income, the same rate he'd pay on a regular paycheck. At a 22% tax rate, $34,000 of every $155,000 actually belongs to the IRS. Then there's the issue of control. At age 73, Jake is hit with required minimum distributions. The IRS forces him to withdraw and pay taxes on that money every year, regardless of whether he actually needs the cash. Those forced withdrawals also count his income when the IRS calculates his Social Security. Depending on the amount, Jake could see up to 85% of his Social Security benefits become taxable simply because of where his retirement money is parked. The 401k balance looks impressive on a statement, but a significant portion of that growth was always the government's property. Jake was simply holding it for them. Now look at Marcus. His starting balance is smaller, at $885,000, but his withdrawals are tax-free. He has no required distributions and total control over his taxable income in retirement. The real value of control shows up during an emergency. At age 50, let's say both men suddenly need $30,000 for a major medical bill. Because Jake is under 59 and a half, he pays a 10% penalty plus income tax. To get $30,000, he loses nearly a third to the government, walking away with about $20,400. IRS rules allow Marcus to withdraw his original Roth contributions at any time, for any reason, with zero taxes or penalties. He takes out the full $30,000 and keeps every cent of it. When you factor in future taxes, forced withdrawals, and the cost of emergency access, the massive lead Jake seemed to have on paper almost entirely disappears. Both Jake and Marcus missed opportunities by going all in on a single account. For most people, the most effective strategy isn't choosing one or the other, but using both in a specific sequence. Financial planners often recommend this 3-step order of operations to maximize every dollar invested. Step 1. Contribute to the 401k, but only up to your employer match. That match is a guaranteed 100% return on your money. Walking away from that is walking away from the best deal in personal finance. Step 2. Max out your Roth IRA. With the national debt at $36 trillion, many analysts expect tax rates to rise in the future. Putting money here now locks in today's rates and protects your growth from those future hikes. Step 3. If you still have money left to invest, route it back into the 401k to reach the higher contribution limit. This allows you to shelter more total income while still reducing your current tax bill. This sequence captures the free matching money and the tax-free growth simultaneously. It ensures that when you finally look at your retirement balance, the number you see is the amount you actually get to keep.